Let's talk about the AMFI data for the month of July first. That has come out and SIP inflows have touched a record high once again. It's come in at over 23,000 crore rupees. Now this July data is also showing healthy growth of interest in new fund offers. But there has been a decline in equity flows for the month of July. And for the week, the Nifty has ended below 24,400. It has been dragged by Grasim and Ultratech Cement. But if you look at the broader markets, the mid-caps and the small-cap indices, they have ended the week in the red. And sectorally, it's the PSU banking pack that was the biggest loser this time. The energy and the realty packs, they've ended in the red too. Pharma and FMCG have advanced in trade this week. But let's get a sense of the kind of retail activity we are seeing in the markets. And for that, Feroze Azeez is joining us. He's the Deputy CEO at Anand Rathi Wealth. Always a pleasure having you, and a very good evening, Feroze. You know, one is the headline numbers that we are citing from the AMFI data that has come out. And there is data that says that mutual funds and retail investors' combined share in NSE stocks has gone up. It has surged to an all-time high, Feroze. From your vantage point, though, how do you assess the quality of investments being made by retail investors today? How evolved are their choices, like buying on dips and selling on rallies, for example?
Yes, good evening, Vikram. If you look at the kind of data which we are seeing from AMFI, we actually predicted that by this financial year end, I predicted that it'll be 25,000 crores a month when the numbers were as little as 9,000 crores. Because the trend is reasonably clear. The retail investor, especially in the mutual fund platform, has evolved significantly. Now, that's a big claim. What data substantiates it is one thing which was very stark to me. Over October 2021 to October 2023, Nifty delivered no return, practically no return, 18,500 2 years before October 2023. In this period, the SIP numbers went up from 11,000 to 19,000 crores in specific months. Before this, whenever there was a market correction or a market lull, the SIPs would stop. I've never seen a period in the last 20 years where SIP numbers go up when the markets were static, go up by 75%. So what was the key reason why the retail investor, especially in the mutual fund platform, has got evolved is because 2013 is when investor education was actually as a structural change being introduced, and almost 5,000 crores post that year has been spent on investor education. And that, I think, is one of the primary reasons why this discipline, irrespective of market movements, is being seen on the mutual fund platform. On the retail side, when you look at the cash market activity, the trading activity has also increased, so has the investing activity. So can't say the same behavioral pattern in the direct equity space.
These investors, Feroze, are investors in India. They're seen buying on days that FIIs are choosing to sell. This is placing a lot of faith in the resilience of the markets for sure, and distinctly different from that traditional perception that we have of retail investors in India, which was that they would buy at the top and then sell at the bottom. But you tell me, is it problematic when you weigh it against current valuations in the markets?
Yes, so Vikram, this is a very good question, but there are two, three very important questions in one. So firstly, I think retail investors used to always do the opposite of what was supposed to be told by the textbooks. But that's changed over the last 2-3 years. Why? Now, if you look at retail SIP numbers in FY21, when Nifty was low, it averaged at 11,000. Nifty did 11,000 average in FY21. In that year, Ultra HNI and HNI sold 1,25,000 crores, but retail bought almost an equal amount through SIPs. So I think they're not looking at the rearview mirror and investing, point one. Point two, if you look at Indian household savings, this is just a small drop in the ocean. If you look at the household savings of India, which is individuals' money as per RBI data, give or take, is 800 lakh crores. If 800 lakh crores is there, and mutual funds is just about 4%, 5% of that, and if you include direct equity also, then you're still speaking about 46, 47 lakh crores out of 800 lakh crores, which is 6%. In fact, India has been underinvested in equity. Foreigners always bought Indian equity and didn't buy debt. Indians bought debt and didn't buy equity. So foreigners were making more money of the India growth story than Indians would. I think that seems to be changing. So there is a lot of money which is there. And I think the faith is now being exhibited, but not, I don't think they're full in. All in has not happened by Indian retail. There's about 3 lakh crores in small caps. That's not even 0.5% of Indian household saving.
Point about household savings. Feroze, there is this strong argument, and it's happened a lot after the union budget has been presented, that many of these retail investors, they don't even save enough to invest in the markets after paying the taxes that they do. And a lot of retail growth in credit is going towards speculative trades like in F&O. Is that concern misplaced, do you think?
No, see, I don't think that's a concern completely misplaced. But I personally think Indian retail is not paying so much tax. It's a perception, right? Why do I call it a perception is, if you look at the new tax regime, which is which up to 15 lakhs, a person pays 9.3% tax. India has a per capita income of just 2 lakh rupees a year. 7 times that, 6.5, 7.5 times that, the tax in India is 9%. Flat, without any deductions, you pay 9%, 9.5% tax, and you have money in the bank account. Any country with 7 times the per capita income taxation being so low is not heard of. But of course, if there are expectations from the middle class, which is going to be there every budget, but they'll still not be using the previous sections which were allowed to them. Coming to the second part, the derivative trading which is happening, of course, it's a concern. And I'm very happy that SEBI as a regulator has always had some amazing vision. RBI also as a regulator, we have the safest, best regulators, I would say, because they think ahead of times. If you look at how the derivative volumes is almost 300, 400 times the cash market volume, and 80, 90% of them losing money, you at least try and caution them with these regulations. Not that the increase in the contract value will suddenly deter somebody, but at least it becomes a news for a person to wake up, and at least 10, 15% of them being a little more cautious. So I think that is not misplaced concern. It's surely a concern. And I think that should be addressed before it becomes a bubble.
But Feroze, just talking about being cautious, as quickly as the Indian markets seem to be shrugging off any signs of global growth concerns like the possibility of a US recession or these geopolitical tensions that we talk about, West Asia, Russia, Ukraine, we quickly recover from domestic cues even like election results earlier this year. But Wall Street right now is on edge. This is happening after a week of these wild swings that we've seen. Do you see signs of sputtering American growth throw stocks into a tailspin on Wall Street and having a resounding effect here?
Yes, definitely this is a possibility. But one thing which I have realized as FII behavior is a ratio of what they used to sell in the US and relative to what they sold the same day in India. As a proportion, if you see for the last 10 years, what FIIs are doing is, of course, they're selling in the US. 10 years back, if they sold an X amount of money in US, as a ratio, if they sold, let's assume 10% in India, the ratio is now down to half. That means if they sold $100 there, they used to sell $5 here. Now they sell $100 there. Now they sell only $2.50 here. Because the relative attractiveness is what the whole game is all about. It's all about relative. If India is one of the stronger economies, it could actually be beneficial for US to slip into a recession. I had actually in December 2022 gone to the US to understand whether just we Indians feel a bias that India's story is shining, India is shining. What's their opinion? And when I met almost people who manage trillions of dollars, 6 out of the 7 of them told that they are India heavy in spite of their negative view on the US economy.
Do tell us, Feroze, if the Fed is pushed into cutting interest rates more aggressively than what had been previously expected, it would be a definite sign, wouldn't it, that American economy is under more pressure from the jobless claims, from the inflation reports. Do you see the Fed in a quandary over here, the need to cut rates, but then fighting the fear of investors hitting the panic button and selling?
Yes, I think the US regulators are very, very worried or very, very agile when it comes to their reactions to capital market movements, unlike the Indian regulators. So I'm very sure if there is a recession fear and if that has a spillover effect to capital markets, the Fed is far more agile in terms of reducing rates more than what they plan, because they like to have a very, very robust capital market. But US has shown a specific behavior of a higher volatility than India over the last 3 years. The reason being, because there is 90% index fund investing in the US, or even more, most of these index funds buy the stock and keep them stored. So there's very little free float available. So these heavyweights, all these FANG stocks, all these large stocks, most of their free float is absorbed by index funds. And index funds are absolutely agnostic to valuation. If an index fund guy gets 100 rupees, for example, in India, he puts 10 rupees in HDFC, come what may. He does not look for what is PE, what is PB. So index fund investing has made US markets more volatile is the hypothesis I'm saying, because there's hardly any free float. So if you see some big stocks like Intel went up and came down 50%, that's because there's very little free float, and every dollar invested is making much larger moves than they would if there was more free float.
So it's about index funds in the US. Back home, among the equity funds, I see thematic funds becoming that much more popular. They've surpassed flexi caps. What do you put this down to, Feroze? And what are you suggesting as a strategy to our evolving retail investors who are parking their hard-earned money, some even saved from astute tax planning? What are you asking them to do?
In my assumed guess, I would say, this is because of the 2018 regulation. See, what has happened is today all asset management companies are launching thematic funds, because SEBI in 2018 said you can have only one fund in large cap, one fund in mid cap. There are 15, 16 categories. You can have one fund each. But thematic as a category is a larger canvas. I can make any theme whatsoever. I can make a theme which says that I will buy companies with only A as their beginning alphabet. And that's a theme. So thematics fund category can have any number of themes. Of course, I was magnifying the example by making a ridiculous statement that I will buy companies with alphabet A. But you can buy MNC companies, you can buy any theme. Theme is a more broader canvas. So most of the asset management companies are fulfilling their product buffet. But a retail investor or any investor should look at completing his portfolio rather than picking a rose from every florist's bouquet. So it is asset management company's job to fill his bouquet of products. It's your and my job as investors to look at what relevance do they have in my portfolio. And I don't think thematic has such large relevance to be attracted towards, especially new funds, which are just beginning, and they'll have a life longer than yours and mine. So what's the hurry?
Retail interest in new fund offers is definitely growing. That's what data is suggesting. But Feroze, largely if the Indian markets are moving up because of retail participation, and simultaneously retail activity is also hotting up because markets are consistently rising, even disregarding some global headwinds, brushing them off, then what is the direction that you're expecting the markets to take from here?
Yes, 40,000 crores of net flow in equity mutual fund category is one of the largest numbers I have seen. Okay, so because 23,000 came in the form of SIP, so net purchase of lump sum minus redemption is 17, 18,000 crores for the month of July, which is a large number. I personally think that you can't blame the retail investor to be agnostic to market valuations because he is still doing his part of investing, not more than 8, 10, 15%, 20%. I've hardly met retail investors who put 80% of their money in equity. You don't find them. So they're putting small amounts of money, but India is a country of many people. So that is aggregating to a large number. And I think valuation is also not as stretched. People don't know, or people don't even track. NSE in small cap 250 has had a 38% growth in earnings year on year for the quarter which went by. People speak of valuations of small cap. They don't speak in the same breath the 38% growth on a quarter-on-quarter basis. I'm not saying it is sustainable, but that growth is also astronomical. Last year, Nifty's earnings was better, 8% better than what was our estimate, and which was the most bullish estimate. Nifty's earnings ended at 1,048 for last year, growing from 820 rupees, which is almost a 28% growth for the full year of FY24 vis-a-vis FY23. So, of course, valuations are stretched, but earnings have done their job to try and catch up with valuations.
Do you see corporate earnings continue to grow in the way that they have in recent times, helping the course of the markets?
I'm not as bullish as in the rearview mirror. Of course, the earnings have been very good and they've pleasantly been far better. Because there is a larger base, I would not expect such large stupendous growths to come. The lower base of 820, for example, on Nifty coming to 1048 is very different than 1048 going to 1300. Our earnings estimate for this year is about 1180 to 1200 on Nifty, which is about 14-15% growth. And if you look at, if you remove the oil and gas sector's earnings for the last quarter, you would see that Nifty has grown 13-14%. Of course, the total number is just about 5-6% growth for the last quarter. But I think oil as a sector has created some degree of dent to the overall earnings. So to answer your pointed question, not that high growth rates because of the lower base we saw in the last year. But I think some just double-digit returns on Nifty growth, I think is possible. And small cap, I think, can grow by about 18-20% for this year, for the full year.
Meanwhile, the resilience of the markets and its trajectory on the way up continues. And we will keep requiring your expertise, Feroze, to help guide our investors on this path. Thanks very much for joining us this evening with your perspective on the way the kind of data that AMFI is providing is panning out and what it suggests by way of retail participation in the markets. Thanks indeed.